Hi everyone, I'm Joseph Tan. Welcome to Basic Business Finance. Let's recap today's lecture, Lecture 2, Part 6. The income statement is also known as Profit and Loss Statement. It has basic three elements: revenues, expenses, and profit. It can be simply summarized as revenue minus expenses equal to profit. Companies may make profit in certain years, but suffer losses in other years, especially during the economical downturn. The profit and loss statement will reflect their profit generation ability during this period. It basically means that can the company generate profit for this year when there's a downturn, example. So in the situation where you have revenue more than expenses, you get a net profit. However, if your expenses is more than revenue, then you will have a net loss. Let's look at expense of a trading firm. We know that cost of goods sold is one major expense. The other typical operating expense for businesses may include selling and distribution expense, general and admin expense, and depreciation expense. There are other types of expense such as interest expense, income tax expense. How do we classify an expenditure as an asset or an expense? This is a very important question. In accounting, you have to classify things very carefully. Expenditure in buying fixed assets and other long-term assets are not expenses. Take note, it's not expenses. When you go for the long-term assets, okay, this basically you spend money on buying a car. So this is an asset. So they are to be classified as an asset because this asset has future benefits to the business due to their long useful lives. Expenditure such as salary for staff, rent for office premises, and office electricity are normally accounted as expenses immediately. So the moment you use them up, you straight away account expenses immediately. As the service provided by these items are consumed in the accounting period. So basically, the rental used for this month, you consume the service, the rental service. Okay, you use the premises, so you consume the service. Okay, as a result, you got to pay for it. They will start work for you. The service provided by the staff to the business, so you can pay for them for this month's salary. So you consume the service, you have to pay for it. This will be expenses. If the rent and other office items are paid in advance, this is something different. Take note, it's in advance. You pay in advance. Okay, you not pay later, but in advance. And the service are not consumed yet by the reporting date. So basically, the service not you pay in advance, but you have not used up the service yet. Then they are accounted as assets at that time, because you have paid for it but not use it. Okay, and you are going to receive the benefit in the future. So this will be considered as an asset. Please take note, this is very clear. Okay, please do not be confused by it. For example, next year rental are paid in advance. Now paid in advance, okay, paid in advance in the current year is accounted in this year accounts as an asset called prepaid expense. Right? So this is a prepaid expense and it is an asset. Let's do example 1 to help me to explain things to you in bite size. I'll break down in bite size so that you can understand it easier. This is the income statements. You can look at the statement again, there's additional two items. Cost of goods sold is deducted from sales revenue to arrive at gross profit. So basically, sales revenue minus cost of goods sold gives you gross profit. A gross profit of 40,000. So this is how you find your gross profit. These expenses are deducted from a gross profit to arrive at the operating profit. So your gross profit of 40K minus a selling expense, your G&A expenses, depreciation expenses, okay, gives you 29,000, which that is your operating profit. The interest and other non-operating expenses are deducted from the operating profit. They do arrive at the net profit before tax. So you can look from here. Your operating profit of 29,000, you less off your interest expense, 1,000. You give you a net profit before tax of 29,000. Finally, your income expenses is deducted from your profit before tax to arrive at the net profit after tax. So you look at the statement now. Net profit before tax, this remember, the word is before tax. Okay, it's 28,000. Less of the tax, 4,760. You give you a net equals to net profit after tax of 23,240. So it's a very simple calculation. At the end of it, you get your net profit after tax. But take note of the sequence, okay, the concept. Understand the concept, and it'll be easier for you. Generally, there are probably four main users here. Okay, the four users of financial statement. These are the four main types. You have this credit grantors, basically the lenders. Next, investors, management, and others. There are three common forms of business organization. We'll touch on the three common forms here. Okay, we have companies, partnership, and sole proprietorship. We have come to the end of this section. Thank you for listening to me. See you soon.